Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make your day. From the first hello to the closing sign, your journey to home is looking divine. The numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make your day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome to another episode of the Educated Homebuyer Live with Josh and myself, here to educate you, help empower you to become homeowners, answer your questions while we're doing it. Tonight, we're doing something a little bit differently. For those of you watching on YouTube and across those platforms, it'll all seem very, very normal. But tonight, we're also streaming from Instagram. Finally, they have the format fixed where we can do both. Could be a complete bust. People might not watch it at all, but the opportunity is there now where it has not been in the past. So want to thank you guys, anybody that's actually watching from Instagram. Appreciate you being here. I don't know how we check questions. I think I can have to look on this screen over here to look at questions from that, but we'll try to answer both. So if you do have questions, make sure you're putting them in the chat. Typically how this whole show goes, so we start with some charts. We update you on what's happening in, the real estate market, in the mortgage market, rates, interest rates, Trump's policies, that sort of thing, whatever is impacting the market, so that we can have educated home buyers. So with that, let us know where you're watching from. And Josh, before we get started, is there anything that you want to get off your chest this evening?
I don't know whether I feel like I'm in the Brady Bunch or in Hollywood Squares over here on the vertical. I feel like we should be doing the goofy jokes. Yeah, we're looking at each other and making goofy.
It's always opposite of what you think, though. It's like, except for the
up and down is easy.
No, good stuff. So let's do this. There's a lot of talk at the moment about Trump's new solution, if you will, for housing affordability, being a 50-year fixed mortgage. You and I recorded an entire podcast on it today. It'll be out next Monday on the Educated Homebuyer Podcast channel, as well as Spotify, Apple, all that good stuff. But let's start tonight, Josh, and just talk a little bit about it. A lot of people, mortgage, real estate, have opinions on it. Kind of a quick synopsis. What do you think? We can throw charts up here as needed, but where do you want to start?
It's kind of a giant nothing. There's a reason why. Here, if I were to boil it down to one thing, there's a reason why the 30-year loan is the most common. It is much cheaper than a 15-year, yet it's still not 50 years. It's short enough that you're making progress. Even though in the early years you're paying the majority of interest, you pretty rapidly start making progress and can see equity growing in addition to appreciation just from principal pay down. When we're talking on a $400,000 loan, picking up $150 of payment savings to add 20 years onto the loan, I start looking at this going, there's better ways of doing it. And that's before we even get into the fact that this is the government putting their finger on the scale over there and saying, hey, we have a supply problem. let's increase demand or by improving affordability in a sort of roundabout way.
Right.
So I don't love it.
No, so there's a couple of things you said there that provide a little bit of context. You said $150 savings, right? That's on a specific loan amount, which we're going to discuss here in a moment. For larger loan amounts, the saving is going to be higher, but the interest that you're going to pay over that additional 20 years is also going to be a lot higher. And we're going to give you some examples here in a moment of what $400,000 loan looks like. Now, for us in Southern California, most of us have considerably higher loan amount than a $400,000 loan. So the savings are going to be greater. The interest that you're paying is going to be greater, but you also said something about potentially pushing off principal or paying down the balance until later in the loan. Why is that important? Why is it important to get to start paying down that principal early in the process? Why is it such a problem if I want a 50-year fixed mortgage and I'm not rapidly paying down that appreciation?
There's not a problem per se. I mean, there are interest-only loans. People take them for a reason. I have an interest-only loan on one of my properties, and that's for a very specific reason. So there's a time and a place for everything. But for first-time buyers who are generally making a minimum down, 3%, 3.5%, 5%, you want to get a cushion. It generally costs 5 to 7% to sell a house. So if it stays level in value, you put 3% down and you haven't really prepaid anything in terms of principal over the first 2-3 years because you have that $150. So if we say on that $400,000 example, the $150, it's coming from the principal pay down. So we're paying down $2,000 less of principal a year. So if we get 3 years into it, you have $6,000 less equity. You could have $6,000 more in your pocket. You could invest that and get a 6, 7, 8% rate of return and have even more. So there's ways that you can look at this, that it's a positive. And we could say everyone, to each their own. You all should have the right to do whatever you want, including take out a 50-year mortgage. The issue is it's essentially a government subsidy when we're saying if it's going to come through Fannie, Freddie, FHA, or VA, which we still know no details, like many of Trump's plans. Here's the plan. We'll figure out the actual plan later on. So from that perspective, that's what it is.
All right, so let's do this. Let's dive into some charts. I think it'll provide a little context. We'll talk about inventory, what's happening nationwide, and then we'll start answering questions. So now is a good time if you have questions to start putting them in. We are streaming here both on YouTube as well as Instagram. So kind of have to go back and forth to see some things. But for those of you who are jumping in now, we've been doing this show for about 4 years, Josh, every single Wednesday, typically at 5 p.m. Pacific Standard Time. This week, the last couple of weeks have been all over the place because of me. I will take full responsibility of that. My kids are in sports, and sports are now on Wednesday nights. And tonight we have volleyball at 5 p.m. So I have to change this in order to make the promise that I've made to the audience, to the viewer, to be here and provide the information, but also to my kids to be there for them. So with that, we're typically at 5 p.m. and we're going to go back there at some point. But for the moment, this is where we are. So Josh, walk us through what we're looking at here. So you mentioned a moment ago, $150 savings. Explain what we're looking at.
This is an example of a $400,000 loan, and we're kind of making some assumptions here on where interest rates would be. 15 years cheaper than a 30-year, so it'd be about 5.5% today. $3,268 a month for your principal and interest on that $400,000 loan. It's a lot of money, right? Especially for a first-time buyer. That's why they don't generally do 15-year loans. If we bump that down to a 30-year, you get pretty big savings. $800 cheaper for adding 15 years to the loan. Interest rate goes up to 6.25%, but that payment goes way down to $24.55. So now let's take this proposal. If we go from 30 to 50 years, the lender has more risk for adding 20 years onto that loan. So they're going to want a little higher interest rate. If we assume 6.65, somewhere in that range, payment drops to $22.97. So that's where that $158 difference in the monthly payment that we're talking about comes from. So you can kind of see we just added the jump from 15 to 30. We had 15 years and you save $800. Now we're talking another jump of 20 years and you're only saving $150. You can start to see why the 30-year has come to be sort of the de facto standard because it gives you the most bang for the buck. And this one here, Jeb, that same scenario, if we get 2% appreciation, what happens after 10 years? Well, with the 15-year mortgage, you're rapidly prepaying the principal. So you would have $321,000 of equity. The 30-year, which is kind of the standard, you'd build up over 10 years, $156,000 of equity. With that 50-year loan, you have $50,000 less equity. at $106,000. So you're getting a marginal benefit in terms of the monthly payment, but you're leaving a lot on the table in terms of principal buildup.
And then we got one more, right? So the Resi Club went out and did an interview, 2,300 or so individuals asking what they thought. The large majority, 65%, said that they didn't think it was a great idea. Now, you brought up a good point today when we were actually recording the podcast. You know, at any given point, about 65% of Americans own real estate, right? That's typically where the numbers.
So the
Hold on, Jeb.
I'm listening to myself.
I'm trying.
What's happening here?
I'm trying to see your Instagram so we see if we have any questions over there.
I'm watching.
I made you start talking.
No, it's all good. So about 65% of Americans own real estate at any given period of time. So it kind of goes hand in hand with that. Now, we don't know if that 65%, all of those people were homeowners, probably not likely. But the large majority of people out there, you know, are saying that they don't think this is a good idea. And at the moment, it's not on the table. I mean, well, I guess it's kind of on the table, more up in the air than anything else. And it's going to take some time before this is there's any sort of progress made on this. But we did go in detail on the podcast. It'll be on Monday. If you want more information on this, the impacts of this, affordability, all of that good stuff, make sure you check that out. So typically, the podcast starts with us talking about inventory because inventory is what drives housing markets, right? Supply and demand. It always comes back to supply and demand. And this year, we saw inventory has been considerably higher than where it's been the previous, years. We were up 22, 23% at some point over last year. At the moment, we're just over 16% more inventory. But this last week, we actually saw inventory come down, went from 856,000, Josh, to, I can't even read the chart here. It's so small, but to 842,000. So probably one of the bigger decreases that we've seen annually. My guess is this is probably the start of inventory coming off the market as we get closer to Thanksgiving. We start moving into that holiday season. Inventory is likely going to continue to come down, which means if you're a buyer, less options out there. If you're a seller, potentially less competition, as long as you have buyer demand in your market. And here in Southern California, things seem to be moving fairly well. So another chart, this was taken rather from another source that we look at, calculated risk. And this just, again, I like to look at 2019. Where do we compare active inventory versus those markets? Because it gives you a pretty good indicator of, where things stand. That was a more normal market at that time. The last 5 or so years have not been normal. And so when you look at that, you see areas like Albuquerque, Raleigh, San Diego, still below the active inventory in those markets. So something to pay attention to. Always like to look at Orange County and Huntington Beach. Orange County sitting at 4,058 properties. We saw a slight jump week over week, 0.44%. So essentially flat, if anything else. You can kind of see it from the chart there. Whereas Huntington Beach down to 233, and we're potentially going to pass where we were this time last year if inventory continues to move down. So we could actually see less inventory on the market here in the next couple of weeks than we were last year, same time, even though we've seen inventory considerably higher for the majority of the year. But week over week, down down 4.72%. New listings again, still up over last year. Again, interest rates are still pretty solid. A lot of markets out there are still hanging in there with regards to, what's happening with buyers and sellers and buyer demand. But understand what we always like to talk about here. Context is very, very important. Last year, as you start moving in this time of the year, the numbers are really, really low. So to get a positive year over year reading doesn't really mean a lot, just because the baseline is so very low as you start to move into the holiday season. But then when we compare it to 2019, we are seeing, most markets compared to 2019, when you look at new listings for this time of year, are still down as to what you would see during that period of time. Whereas year over year, a lot of those markets are up. Something I found interesting when looking at this, Josh, if you look at active inventory in areas like Jacksonville, Florida, inventory is considerably higher. Active inventory is considerably higher than it was in 2019. But then when you start looking at new listings, right, most of these markets are positive, compared to year over year, but yet Jacksonville is one of the markets that has the most inventory, but yet it's down. So have they reached some sort of peak there with people just willing to sell property, or is it just a slowdown due to seasonal activity and other things going on? Hard to say.
Going back, Jeb, one of the very first episodes of the podcast that we did, we're closing in on 200 episodes. One of the first 5 episodes was why home prices are sticky to the upside, because most people are owner occupants. They live in that home and they don't like the idea of selling it for $1 less than the peak that it ever hit, as represented by another home in their neighborhood, regardless of whether that home was substantially superior to theirs. So I think you're definitely seeing some of that, and some of that lock-in effect where people are just saying, I'll just post up here. There's no reason to move. So you're not seeing this massive buildup in inventory, because if it does, then the only way to clear it is for the homes to come off the market, people to take their home off the market, or to accept whatever price the market is willing to bear. And we're seeing some of both in the weaker markets, but definitely seeing more people canceling their listings than we historically see.
Now, Josh, we're going to go off script here for just a moment, because we have a question on the 50-year fix, and I kind of want to address it as we're going through this. So I don't know if you can get us back to our side by side that we typically look at there when looking at this, but let's see. So the question, Josh, is it's from somebody in the mortgage business here locally. Just says, I don't understand why real estate professionals are comparing the 50-year to a 30-year. You should be comparing a 50-year to renting forever. No, question mark. And I understand the context behind that, right? Renting forever versus owning something.
I don't. It's a silly phrasing of the question. We can sit here and give you five massive ways that it's different, but go ahead.
But let me explain. In most markets right now, considerably more expensive to own a house than it is to rent, right? So if you're comparing it to renting and versus owning for over a 50-year period of time, very hard to compare the two, because you're paying considerably more to own that house, considerably more in interest. There's a lot going on there. So it's not an apples to apples comparison in many markets. But what's your take on it?
Well, we showed the chart there. In 10 years with a 50-year mortgage, you have $100,000 of equity with 2% appreciation. So a small portion of that is the principal reduction, because we've stretched it out so long. But that's 2% appreciation. We know historically, if we ask what happens over the next 25 years, homes are going to go up more than 2% a year. What's going to happen in the next 2 years, 5 years, 7 years? I don't know. All bets are off. That's much harder to predict. Sure. But over the long haul, we know it's going to hit that number. So when you flash forward, the renter doesn't have that. And the renter today saves money, right? Cheaper in most markets to own, to rent than to own. So there's a difference in that for their favor, but they're not fixing their costs. So it's going to go up, and it's going to go up 3.5%. So again, 25 years from now, 10 years from now, 8 years from now, in almost any scenario, the homeowner is going to come out further ahead. Does this mean that I am a big fan of the 50-year and I think you should do it? I don't. The 30-year is kind of that sweet spot where we minimize the monthly payment and maximize the equity buildup without making the payment higher than it needs to be. But to compare the two, or people saying, well, you're just a renter forever, you're stupid. If we go to a world tomorrow where there's only 50-year mortgages or renting, I'm not going to rent anything. So I think that to equate the two as being the same is silly.
No, I don't disagree with that. I think there are pros and cons to all the scenarios, and it's really a personal thing. As long as you understand the downside to it, and like we discussed in the podcast today, then by all means, if that's your avenue to becoming a homeowner, and that's your option, I think that's the right option. But for a large majority of people out there, I mean, for everyone out there, I think the 30-year fix is definitely the better of the option. And with $150 savings or whatever the savings is, I don't know if it's worth the risk, the downside risk of home prices moving sideways in a lot of markets and people having to get out earlier than they originally thought and having to deal with all of that. But nevertheless, so let's go back, Josh, as we were talking about inventory. We're going to breeze through these real quick so we can move on. Weekly pending sales still up week over week. Interest rates are lower than they were the same time last year. Still have buyer demand out there in the market. Things are still moving. Percentage of price reductions kind of moving flat, if you will, over the last, 2 months, sitting at just over 41% of homes out there have some sort of price reduction on them. It's always important to note when we're talking about this, that a price reduction means very little, because prices could be priced high to start with. So just because a property's had a price reduction doesn't mean really anything to some degree. I mean, yes, there are a lot of homes out there that need price reductions that, have been sitting on the market for a considerable amount of time that probably are priced closer to fair market value, but there's also a lot that aren't. So take that with a grain of salt. Find a pro in your market that understands what's going on, have them run comps. That's really the solution to the idea of some sort of a big discount coming to the market. So spreads, Josh, we've talked about it, continue to come down. We've seen the 10-year kind of fluctuate between 4 and 4.1, just over 4.1. With that, spreads are continuing to compress, not by a lot, but by a little bit. And with that, interest rates are still sitting here in the low 6% range. Nothing much to talk about on that front. But let's talk about this, Josh. Housing essentially becoming less affordable for first-time home buyers. We talked about it today. The average age for a first-time home buyer is 38 years old. So imagine doing a 50-year fix if you're 38 years old. Who the hell is going to pay the mortgage when you're 75 and you don't have a job and whatever? But that's a different scenario. But what are we looking at in this chart?
What I really wanted to show with this, so we talk about 3 ways that affordability can improve. So it's funny that the headline is housing becoming less affordable. When you look at the orange bar up at the top, it is starting to turn down, meaning that homes are becoming more affordable. Still historically unaffordable, but more affordable than where they were at the peak. But what we're talking about here, there's only 3 ways for affordability to improve. Home prices come down, interest rates come down, wages go up. So that blue line is median family income, and you see it going up. So people say, hey, interest rates aren't going back to 2 or 3%. Wages kind of go in a pretty consistent pattern upwards. So the only way we can correct is home prices have to crash. The last time we got this far out of whack, we see there in 2007, home prices crashed. And talked about it a million times. The more likely scenario is that blue line slowly goes up and the orange line goes sideways for quite a significant period of time, 3 years, 5 years, 7 years. So I think we're kind of now finally entering what the new normal looks like. If we look at no matter whose number you look at, most people are saying year over year, 0.5% to 2% appreciation. I think that's kind of what the new normal looks like, because the affordability is at a point where it can't get pushed higher. So if rates drop from where we're at now in the low 6s to the mid 4s, that will bring that line down. It could be mitigated by some people jumping back in by this newfound affordability. But the thing that's going to save us is time and that blue line coming up until eventually it meets the orange line and we're back in line. So this is one of the reasons why I say I don't like the 50-year mortgage, because what we're doing is artificially pulling that orange line down. One of the questions here, someone asked, hey, this reminds me of 2008. It's really in no way similar, other than this is a product that marginally increases affordability as judged by the payment, while introducing a small amount of additional risk to the system. But I thought it was an interesting chart nonetheless. This kind of tells you the flip side, Jeb, of saying the average first-time home buyer is 38. We're now at a low going back to 2003 of 21% of first-time home buyers. What was interesting to me is we had kind of settled post-2014 into about 33%. About a third of buyers were first-time buyers. Obviously, in 2022, when affordability got whacked, it dropped to 26, and somehow in 2023, it jumped up to 32%. But with affordability where it is, you're going to have more home sales. So we have record low home sales, and the home sales that we have, 80% of them are among homeowners. I'm selling this home, I'm buying this one, not people first entering the market. That's not healthy today, not healthy for the long haul. But of all of our solutions for correcting, time is the one that is most likely. You and I went through this morning, Jeb. I'll just buzz through this really quickly. We have had no data for the 40-something days that the U.S. government has been
government data.
No government data, correct. Very important distinction, because what's interesting, Jeb, what's been really interesting is additional private companies jumping into the breach over the last 40 days and coming up with some really cool data that fills these gaps and may actually be better than the government stuff. But CPI, the October report, was due to be released tomorrow. That will be possibly canceled altogether because we missed 40 days. Those people have to come back and compile the data and then present the report. So it could be canceled and then just sort of bundled with the November report, which is due December 10th, but they're saying could be a week late. The jobs report, September jobs report, was due October 3rd. That could come out next week. We'll see. The October jobs report, which was scheduled for November 7th, is going to be delayed at least 3 to 4 weeks. The reason why these timelines are important is we get the final Fed meeting of the year, December 10th, and they're unlikely to get much, if any, of this data prior to then. PCE, the Fed's favorite measure of inflation for September, was due October 31st, but will now likely be released in late November. The October report, which was due November 26th, will likely have a delay as well. So the bottom line is, at that next Fed meeting, the Fed's going to be having partial data at best and rushed data. So they probably get this data, Jeb, before you and I do, before it gets released to the public. So hopefully they're getting a preview and a look at some of this. Some of this private data, this is Challenger Gray and Christmas. They post job cuts every month. And we had this data come out last week, 150,000 job cuts in October, which it's a lot. It's a lot relative to where we've been. We've been, 60 to 70,000 for the last 5 to 6 months. But you can see in February and March, we had even higher figures. So you need 3 to 4 months of this trending up and staying up to really become a trend. This chart, Jeb, you may look at and say, Josh, you put the dumbest chart I have ever seen into our slide deck here.
No, you've done worse.
It's 2 boxes. We can't learn anything from 2 boxes. This is actually a really cool report. ADP, in addition to their monthly report, has started doing a weekly report, and there's a lot of noise in a weekly report. So that weekly report is a 4-week moving average. So last week it showed that we had almost 15,000 jobs created monthly on a 4-week moving basis. And this week it went down to 11,000 lost. That's a $25,000 difference in 1 week. In the last week, Jeb, the only thing that happened is 1 week of data fell off and 1 week of data came on. For it to move that much in 1 week, last week was really bad data. So it's showing the more recent data is much worse than where we were even a month ago. Always want to keep an eye on inflation. The only good look we've had at inflation is Truflation. Last week, this was at 2.66, so we're down to 2.55. It's volatile. It's noisy. It is still clearly trending up if we were to put a trend line on there. So we would love to see that get back down under 2%. What is this telling us? December 10th Fed meeting, we are now down to a 60% chance of a cut. Last week, I think it was up at about 62%. So I don't know. If we don't get some additional data before that December 10th meeting for them to sink their teeth into, very easy for them to say, we're going to pass and just.
Well, there were a lot of Fed members out today in the market speaking about, because they're getting ready to be on their little hiatus here and not be able to talk to the media. And so all of them were out and doing their thing. And there's a belief that, hey, listen, we should pause until we get more actual data out there in the market. So, if you look at the Fed, you would think, hey, that's probably the case. December 10th might not actually bring what we thought it was, which is another Fed cut. But then when you look at people placing real bets in the market and the Fed probability, 60% of the market still thinks that there's likely a Fed cut coming just based on the data that's already being provided. So continue to update you guys as we get that data. But at the moment, it's there. And for those of you listening thinking, okay, so they're going to reduce in a quarter, that means interest rates come down a quarter. Not how it works. Remember, we're already talking about this. The market expectation is that that's going to happen at the moment. The higher probability is that there is a cut. So kind of already priced into the market, right? If that probability starts to move, chances are you see interest rates probably trend up just a little bit because it's going to take away some of what's already built in there.
Well, let's say, Jeb, if it's a 60% probability today, if the Fed meeting was tomorrow and they were to cut, that would be something of a surprise. 60-40 is a coin flip at that point. It'd be somewhat of a surprise, and you would see an improvement in mortgage rates. But that's not generally how it happens. Between now and December 10th, you would like to see it go to 62, 68, 69, 74, and then the day before, generally they have a pretty solid feel for where that's going to go. So we can watch that number and get a much better handle on the way the market is betting. So our down channel here that is going back all the way to like late May, early June, Jeb, was breached last week, and was kind of worried that we were going to run up to that 418, 417, 425 level, even if that were breached. We are barely back inside of it as of today, and that was largely based off of that ADP data. It's the only good data we've had to sink our teeth into, and the market goes, hey, maybe the employment market is worse than what we think it is. So day over day, some nice improvement in interest rates. Week over week, most of that just came in the last day. So really, day over day, week over week, even month over month, we've been pretty flat. Not a whole heck of a lot of movement since that last Fed meeting, but the year over year is kind of important here. Look at 30-year fixed conventional, 0.75% lower than where it was this time last year. They've got FHA and VA at 40 basis points, so 0.4%. I would have to take a look and see how they're compiling that. They should be very similar. But anyway, you cut it 0.5 to 0.75% better than where we were last year, which does improve affordability, even though it's only marginal. And it does kind of put a floor underneath the market, which is kind of why we're seeing this stagnation just slowly moving forward at a small amount of appreciation.
All right, good stuff. So if you're buying, you have questions about the pre-approval process, looking to find a real estate agent, there is a banner that is scrolling on the bottom of the screen there. You can click on it, get in touch with Josh and myself and the team here, and we can walk you through what that process looks like, guide you in the right direction, right? The goal here is to buy right, borrow smart, and ultimately build wealth. So tonight, Josh looks a little bit different in a couple of different ways. For one, that banner scrolls at the top on Instagram, which is really weird. But we're streaming to Instagram for the very first time. This show, from this point forward, what kind of provides the information now that we've gone through charts is the questions that come up. So we're streaming on YouTube. That's a primary platform. It has been for the last couple of years. And that's where the large majority of people tune in. But for those who are watching on Instagram, we appreciate you. But what we're going to do is start answering some questions. If you have questions, let us know. Instagram, we can actually hit the questions and pop them right up on the screen so you see what we're talking about, or at least I think we can. It should stream to Instagram as well. But as far as YouTube, you'll see it like normal. So, Josh, let's dive in, and kind of go through the list here.
Do you want to give first word of the day to the first comment on the Instagram feed?
Let's see. I don't know. We had some earlier, but we kind of addressed a lot of them around the 50-year fix. So I think we're good on comments there, on questions at the moment.
Let's just, Charlene Shirley, we can't throw it on the screen, says, a newbie here, passionate about real estate investing. I heard the 50-year will slow equity growth. We went through that. The charts definitely bear that out, but I just wanted to give her a shout out for being the first commenter over there.
There you go. Good stuff. Good stuff. All right. So, Mr. Josh, we got some starred comments here. All right. So there's a lot of talk at the moment out there about credit scores, right? So FICO is no longer the only model. Vantage Score is making its appearance here shortly. But there have been some changes to FICO. There have been some changes in Fannie Mae guidelines. At least I think are coming. I don't know if they've actually come yet, Josh, where DU no longer requires a 620, right? Is my understanding, something along those lines. But the question here is, if credit scores are made obsolete, was my effort to maintain credit in vain? And so, Josh, lenders aren't going away from credit, right?
Your credit scores are absolutely not obsolete. You can go and Google and search for the Fannie Mae or Freddie Mac loan level price adjustment matrix, and it will show you the same matrix we had yesterday. So the fact that the minimum credit score requirement was taken out of the automated underwriting systems, as of today, there is virtually no change. No announcements from any of our investors. We're approved with over 70 different investors that do Fannie Freddie loans. Not a single announcement in reference to this, because no one really knows what it means. Part of this is just putting some leverage on FICO. They're wanting them to use the 10T model. We've got Vantage Score. All of this is sort of theater and politics behind the scene to sort of leverage them to back off of these egregious, excessive increases in credit prices that we've seen post-COVID.
All right, Josh, we got the problem with streaming to Instagram is that when you're here on YouTube, when I put up the comment, it literally covers my face. That might not be a problem for some people. That might actually be a good thing. But
it just looks like a hat. It's just like
the hat talking
you over there on Instagram.
It can become really weird. So we're going to throw it up there. We might take it off just so that we can actually see what's going on. Another question, Josh, around that 50-year fix that we kind of started the conversation, asking about, is it realistic for a 42 basis points add on a 20-year if you're adding 72 basis points on a 15-year? So we talked about it in the podcast today we recorded. There is a difference in interest rate from the 15-year to the 20 to the 30. As you add duration to that loan, it becomes more risky for the lender. They have to keep that paper longer. Therefore, they want a higher rate of return. The idea, at least from Logan Matashami over at Housing Wire, is that the 50-year is going to add somewhere between 42 basis points to, I think, 72 basis points, which is essentially what we put here, to that loan. What do you want to add on that? Anything? I mean, we don't know what that actually is going to look like, but
we don't know. So let's leave it to the pros. Logan ran the numbers. He says 42 to 57. So the 72 that he was mentioning, there were 72 relative to the 15-year. In general, the yield curve doesn't continue to steepen further out the curve, but that could change. I mean, 30 years is a long time. If the market is concerned about long-term inflation, it could be more than that. No one knows. Most importantly, I don't think anyone needs to care, because I don't think anyone's going to come of this 50-year mortgage idea.
All right. Let's see. So got a question from
Dungeon Dojo.
So the 50-year won't make sense for anyone if it doesn't save more than the current numbers suggest. How do you think they'll remedy that issue? Better interest rates, subsidies, something else? So I don't think they need to remedy anything. I think savings is savings, right? And Josh, unfortunately, we've said it for years, and it is true. People live in the payment, not the price. Not even in the terms, so to speak. There will be people that take the 50-year loan if it's made available, take the savings, move on, and maybe do well if they own it long term. Maybe pay some consequences if they don't, just because of the lack of interest and principal being, or not the lack of interest, the lack of principal being paid during that period of time. But any thoughts you want to add on that?
The only way to make it go away is subsidize it. The government has to force the price lower. So this is a bad idea, for the million reasons that we've discussed earlier today on the podcast, here on the lead into the live. It's a bad idea. It's not going to go anywhere. It doesn't have any support from politicians, from the public. I don't think anyone other than just a first-time buyer who's completely priced out of this market is thinking, yeah, I want that.
No, absolutely. So the question is, when are we going to get over 200 concurrent viewers? So Sam, back in the day,
that was a small number back in
200 was our low. And we've fallen off the wagon. We're no longer
need a COVID time machine when everyone loved real estate.
We're no longer interesting to the market, and we've answered every question out there. So no people don't find us valuable anymore. So therefore we are we don't get the views that we once did. But anyhow, we appreciate you being here, appreciate the support. If you're finding any value, make sure you hit that like, subscribe to the channel if you haven't done so already. If you're on Instagram, you can do the same thing. Hit the thumbs up. No, hit a heart. That's what it is. All right. Okay. So a lot of questions around 50-year fixed mortgages, Josh. If a middle-aged person chose to use a 50-year fixed mortgage, what happens if they pass away before the loan is paid? Are they passing the mortgage on to their child or their children, rather, if they have any? So it really works no difference than if somebody gets a 30-year fixed mortgage and they pass away, right?
Make the question more universal. I did a refinance last summer for a couple. They were 78 and 79 years old. They did a 30-year loan. Probably not going to make it to 108 and 110.
Yeah. The lender doesn't discriminate based on the duration of the loan, unless it's a land lease or something like that. And that's not really discrimination. That's just protection of themselves, because they're looking at the ability to repay, right? Down payment, credit scores, all of that good stuff. And at the end of the day, if they were to pass away, the property doesn't pass along and gets foreclosed upon, the lender has hopefully done their due diligence and able to protect themselves and not walk away upside down on that investment. So, but at the end of the day, does not matter in that scenario, one way or the other.
Sometimes heirs have this question: just what happens? Well, you inherit the property, but the debt is tied to the property. It doesn't become your debt. If you don't pay it and it goes to foreclosure, that's not against you, it's against the dead person. But it's still a debt against the property. That is the purpose of a mortgage or a deed of trust. It's to tie that debt to the property. So you can refinance and pay it off. You can sell and pay it off. You can take money out of the bank and pay it off, or you can let it go to foreclosure. Your call.
All right. Let's see. Not a lot. Do we have any additional questions here, Josh, as I'm scrolling through Instagram? Not a lot of questions, just some people watching. So we do have Brian down in Tampa just saying, loving our inventory, getting his ducks in a row to buy in 2027. So I think it's a good time, Josh, to talk. So Josh and I, last year, we did 2 home buyer workshops, webinars, if you will. And from those 2 workshops, 7 people that went through it. I don't know how many people went through it total. Way more than 7, but 7 people ended up buying homes using Josh and myself to do so. And for that, we were grateful. But here's the thing. We're doing the same webinar again in December for those looking to get ready in 2026 to become homeowners. December 9th. It's a Tuesday. It'll be at 5:30 Pacific Standard Time. It'll run roughly 90 minutes, typically probably a little bit shorter, but we'll take some time for questions. And this will walk you through what it looks like to buy a home. In 2026, we'll kind of go over the pre-approval process, what lending looks like. We'll talk about the home buying scenario as well, kind of walk you through the pieces of the puzzle there. So you'll leave with some basic knowledge. It's surprising how many times, I guess it's not surprising. I do this every day, so I forget that most people don't understand this, but people ask, like, what does this look like? What am I supposed to do?
Where do I start?
Sure. And this is really what that's about. So the easiest way to get there, I don't know if we have a link on the screen, Josh, but it's theeducatedhomebuyer.com. So theeducatedhomebuyer.com/workshop will bring up the landing page. And from that landing page, you can fill out the information and you will get the information to join the webinar or the workshop rather. And for example, you sign up, you don't get it, you'll still get the replay video. So you'll be able to watch it and, provide the information there. So Josh will throw it in the comments here in just a moment, I believe.
I'm going
With that, Mr. Josh,
I'm going to get her on a scroll for us.
Josh, I want to take a minute here and talk about this because this is something that keeps coming up a lot. I had a conversation with some first-time home buyers the other day. I was telling them, hey, you need to go through the pre-approval process, right? They're early in the process. They're not really in a hurry. And they're like, well, we kind of know where we are. And I'm like, okay, tell me what you mean. And they said they knew their credit scores. Hey, I'm in the 700s, low 720, whatever. What are you using? Well, I've got different things that I look at. My credit card, I've got access to Experian and all these things. That's a Vantage score model, Josh. So explain the difference in what a lender uses presently versus what you're able to see when you look up these different credit modeling on different websites that you have access to. How is your system different?
They're truly different algorithms. Even within Vantage Score has a mortgage model that we're going to be using once it gets rolled out at some point. They were saying hopefully by the end of the year. We've got 45 days before the end of the year. I don't think it's going to happen. But there's different models. So within FICO, 30, 40 different models. Within Vantage, 30, 40 different models. The ones that are made available cheap or for free, so whether it's on your credit card, Credit Karma, any of these is just a lesser model. It's a lesser algorithm. So the best example that I can give, I don't have any tie to this, but I use Experian for my monitoring, and you can monitor TransUnion and Equifax through Experian. But when you look at it on your Experian, you can go and it will show you all of the models. There's like 5 or 6 different credit card models. There's 3 or 4 different auto models. There's a few different mortgage and rental for renting a home models that are just cheaper and better and easier to get. And there's a pretty wide range. And for whatever reason, the mortgage models seem to have the lowest scores. Whatever they're weighting, whatever they're looking at, generally a little bit lower. The higher your score is, the smaller the delta between the mortgage score and one of these lesser scores. If you have a 650 score, you could easily have a 605 or a 610 score when you look at the mortgage models. When we look at someone with an 800 credit score, probably still going to be pretty darn close to that, although 5 to 10 points lower. So I don't know if that helps, but that's the differences there.
All right, good stuff. So I happened to scroll across something, Josh, today prior to getting on here. I didn't have an opportunity to dive deep into it, but there's a question kind of along the same lines, or asking the question of what I saw, and it's thoughts on President Trump's new plan of a portable mortgage, essentially being able to take your current interest rate and terms to a new home. I haven't read on this. I don't know the details of what he's suggesting, but what I can tell you without even reading or knowing the details, if I'm allowed to take a 3% mortgage on the current house and buy a bigger house, a bigger mortgage, and take that same loan to it, which I don't know how you would do because of the servicing rights and everything else that's involved here. That seems like just somebody throwing things around that don't truly understand how this works. But if that's the case, I'm telling you right now, prices would go up considerably because it would allow so many people to get out of their current situation, buy the more expensive house that they're wanting to buy already, but they're not doing it because their interest rate is different. And so it's a whole different scenario.
Apparently, I'm just contrary, because the first thing I want to say, Jeb, you're wrong. And then I start thinking about it. I look at my situation. If I could take my $600,000 remaining balance at 2.75% and go buy another house, I am going to be infinitely more likely to go and buy another property. The question then becomes, is there so much more supply on the market? Does that additional demand just get absorbed into it? It's certainly not a negative for home prices.
Sellers are buyers. Sellers are buyers. So is it really net inventory? I mean, that's the thing. And maybe to some degree the answer is yes, but I guess I don't know enough about the plan to even dive into detail on it. We'll dive, we'll look into it a little bit more and have a better conversation, exactly what's being thought about, and then come back with a little, an arsenal of talking points. So rather than just shooting from the hip here, Josh, so Kevin, Kevon asked us to do a quick explainer on the 50-year being counterproductive. We started the episode today by talking about that. Go back and check out the beginning of the episode. You can watch it. It'll be there, and you can get.
And
all
if
the
that's not
points.
enough detail, just wait till next Monday.
Next Monday on the Educated Homebuyer podcast, we were talking about it in great detail. In fact, it's going to be a long episode, 25 minutes or so, where we dive into to those details and give you the information that you're looking for there. Josh, nerds are underrated. I'm assuming, and then he thinks this.
Nerds,
so I'm assuming
nerds the candy or nerds the humans.
I mean, I think the humans, because nerds the candy are not underrated. They're overrated. Overrated in my household. Now the clusters I can go for. The individual nerds, I don't see the appeal.
Well, hey, let's give a regular, consistent, all-star viewer. Dixieland says, "I'm for anything that will help someone to own a home, but hopefully they can get out of their 50-year mortgage if they get one." A comment that I made in the podcast recorded today, and I hope it doesn't get misconstrued, is if we're going to do this, I would rather see an interest-only option and only available one time for first-time buyers. And maybe the interest-only period is 5 years, and then it's a 30-year fixed after that. And before you think that sounds crazy, again, this isn't just so everyone can afford a home or push home prices up, which it would do because it would increase buying power for many people and allow them to get into a home. But what it would do is if you have a 3% wage increase for 5 years, you're going to be up almost 20%. So it fixes itself by the time you get to that amortizing period, which would be the normal 30-year fix. So there are other options that are better options than what we're proposing here. But I digress.
Well, here's the thing. So Charlene has a question that I want to just kind of go over, Josh. I don't know if I have the time to do it right now because I'm limited on having to leave because of kids' sports. But she says, would you consider going over an active listing? One, I'm considering using creative financing, talking about hard money as a bridge to a DSCR loan. It's a fourplex in Huntington Beach. I do want to go over that. Shirley, I'm happy to have the conversation. We're happy to have the conversation off air if that's helpful. Just to answer the question. I don't know if we have enough time to go over it now, but if you want to put it in there real quick, I guess I would probably have too many questions though about rents and everything else that it needs to be factored into this in order to kind of give you a detail
of the podcast where we just break down her whole scenario, or any of you others. If you're wanting to get into the market and you would like to do a 20-30 minute conversation on camera where we'll break it down, we can blur your face and use a different name and change your voice and all the things like they do on 60 Minutes. But I think people would like that, like to see what that process looks like for everyone.
All right. So Charlene, send us the information. You could do it outside of this scenario, just so people don't have the personal info of everything that you're doing there. You can send me a DM. Happy to have the conversation, or you can call us, information's there online. So Josh, a couple questions before I have to jet. Omar says, if I want to buy an owner to owner property, is it safe to basically get a real estate agent? Do I need an agent to represent myself if I'm just buying somebody's house down the street? This is going to sound very self-serving. I would say yes, in most cases, unless you understand disclosures and paperwork and that sort of thing. If you do, or you can have an attorney or even an agent review them, then you're probably okay. But you do want some protection, right? You do want disclosures filled out. You do want some due diligence done, just so that, I's are dotted, T's are crossed. You're not buying something. But importantly, home inspection still needs to be done. You still need to review seller disclosures. If there's an HOA, you still need HOA docs. Depending on what you're buying, potentially an appraisal. So there's a lot of things that go into the home buying process. A lot of things people think, hey, Jeb, it's your job to find me a property. That's not my expertise, guys. My expertise is once you find the property, that's where my expertise is, helping you negotiate, helping you look at things, helping you make a decision on whether or not it's the right opportunity and the right property for you. So Omar, depends on your scenario. But I would say more often than not, try to get somebody there to that at least understands the process to take you through it. And if you're doing a for sale by owner in any situation, you still need the stuff that we're talking about here, guys. It's important. There's a reason this stuff is done. It's there not only to protect you, but it's there to protect the seller in some cases as well, because if something happens, you go back and sue the seller and, something wasn't disclosed. It's litigation. It's,
I, I
go
know
ahead.
you got to run, but what you were saying there, litigation wise, I'm going to give you the perfect example. I was just up at my in-laws this summer and they said, "You're not going to believe this. When we look across the street, there's a house over here. We look across the street, there's a house over here." And the parents owned this home and they built this one over here for themselves. And they sold the home to their kids for sale by owner. No contract, no inspection, no appraisal, no lender. They carried the paper on it. The kids never made a single payment from 2019 to today. And you're like, dirtbag kids, you haven't heard the beginning of it yet. The kids found out that the home was built by the parents and didn't have a proper foundation. So now they are suing the parents for $500,000.
What are we talking about?
And carrying the financing and not getting a payment over the last 6 years now. So that is truly like your worst case scenario. And you would think that the risk would be to the buyer, but no, in this situation, the risk was to the seller for their dirtbag kids not making any payments for 6 years and then suing them because they can't. What they did, Jeb, is they wanted to put a sign in the yard. They did put a sign in the yard to go and sell the home. And they took a contract for like $700,000, accepted an offer. The house they paid $300,000 for. Those people did an inspection and go, "You don't have a foundation here. Who built this house?" We're like, "My idiot in-laws built the house." They're like, "Let's sue them." That's the craziest story I've ever heard in regards.
It's crazy enough. All right. So here's the deal, guys. I appreciate you being here. Josh, I'm going to let you take over YouTube, Instagram. We're going to see you live next Wednesday at 5 p.m. Pacific Standard Time. So appreciate you guys watching. If you have questions, make sure you reach out. That one, Josh, I ended. So you are just here on YouTube right now.
I was going to go wild with some fun stuff on your Instagram, Jeff.
Yeah. So
you're lucky.
I did.
You're lucky you shut that down.
All right. So I'm going to let you take over for the last 10 or so minutes to take this out.
All right.
All right. I'm just going to say my adios right now, Josh. Adios.
All right, amigo. Okay, so let's jump in here, see what additional questions you guys have. Anything mortgage or real estate related, throw it in here. Josh, who is also this guy, Josh, says, "What are some things you can do when home insurance comes in higher than expected due to the very high fire risk zone?" So if we look at that, you do not have a lot of options because many times the risk exceeds what any prudent insurer would ever insure. So if you're in California, and many parts of the country, they have government fire insurance. So California Fair Plan here in California, although those premiums are massive, they don't in any way cover the actual risk to the state of California. We could have one of these fires really, really be problematic for the California government. So the fire stuff is a very unique issue. Flood is the same. Flood is generally, the majority of those policies are government policies through the National Flood Insurance Program. That quote is largely what it is. Call multiple insurers, see if there's private insurance. If there's no private insurance and you fall back to the government, that premium is going to be the same just about any insurer that you go to. So if you can get a private policy, definitely check it all out and check out multiple options and see what you can do. So let's roll through here and see if we have any additional questions. Oh, so here's actually a good one. Willing says, should I compare and shop my homeowner's insurance company every year, or is it pretty general across the board? They're generally pretty consistent, but as time goes on, the premiums get higher. The differences from one insurer to the other can be large. I just found out for the 87th time, I kid, like the fourth time in 4 years, that my premium has gone up now about $500. So at this point, that's the final straw. We will be shopping that policy. There's absolutely no downside to it, right? You shop around and find out you have the best deal there is in the world. It can be a good thing. So I've got multiple insurance options here, as you would imagine. I need to take my own advice, take my own medicine, and go and shop my policy, see if we can get a better number. And we're not answering Indiana Jones, Wolverine, or Batman questions. So Lauren, I want to go back to your earlier question. I know you said there that you are interested, but I could have swore, yeah, here we go. So Lauren says, we put an offer in at asking of $575,000, but they went with another offer. Since then, the house is now up for foreclosure auction, starting bid $297,000. So we know that it needs a new septic. How can we get it at the auction? So here is the $24 million question. Has the foreclosure happened? Does the bank own the property? Or is the bank intervening and saying there's going to be an auction of the property? So generally, that auction, that trustee's auction, happens at the courthouse steps, and you have to have cash to pay for the property. Some situations, there's a different type of auction where you can put a deposit down and then align financing over the next 30 days or so. But those are few and far between if it's truly just now going to foreclosure and you're wanting to bid at the trustee's sale. So if we're looking, I don't know anywhere that home prices are down 50% in the US. So if that 297 could tell you a couple things, those people that went over and bid over, when you guys over asking price, when you guys missed out on it, they could have put a large down payment. Oftentimes that starting bid is how much is owed on the property. So they may owe 297, and that's just where they're starting at. Generally, if that property, let's say it's down 20%, let's say that it sold for 600 and it's now worth, 480, 500, it's going to generally go over 297, depending on where you are in the country and how active investors are. Here in Southern California, anything that smells of a deal, there will be 5 to 15 professional investors at the trustee sale with a pocket full of cashier's checks in different denominations where they can hand over the money right there and pay cash for the property. The other thing to be super careful and wary of as a standard buyer wanting to get into that, if you buy the trustee sale, you don't have title insurance. So you're not going to know that you are getting clean title, that there's not things like IRS liens or anything else against the property. So you want to do your best title research and ascertain to the best of your ability that there's not any excessive or undue risk there in you buying that property. Miscellaneous of the whatever. This is the angle of this we hadn't covered. You expect PMI to be higher for a 50 versus a 30. It's higher for a 30 than a 15. So I don't see why it wouldn't be higher for a 15. You're building up equity slower. That represents more risk to the mortgage company, more risk to the mortgage insurer. So it would be a reasonable thought there. So Derek says a 50-year mortgage makes a lot of sense for the banks. I don't know. I don't know if it does. I mean, how much more are you going to make there? Like there's so much more that goes into this. We had a great relationship with a credit union through, the early part of 2023 that they didn't have a sales team that could get them enough mortgages to put on the books. They wanted to take some of their depository funds. They wanted to invest them in mortgages. Well, when rates went up and they no longer had portfolio churn, no one was paying off their loan with refinances. They're like, we have enough mortgages. So oftentimes the profitability of mortgages on the books comes down to what the cost of funds is for the bank. Is it a portfolio lender? If we're talking about these are not going to be Fannie Freddie loans. They're non-QM. So what is the value of them in the secondary market and long-term to investors? There's so many unknowns here. Steve, we kind of at the counterpoint here, 50-year could be a good option if you use it wisely. If it helps you qualify for a more expensive property than your current conditions allow, you could always refi as your earning power increases. That's absolutely the thought there. Could it be used prudently? Could it work out? Yes. I'm just not sure the juice is worth the squeeze in terms of the additional risk to individuals and then the additional risk to the system as a whole. Apologies there. I couldn't get to the mute quick enough, but let's scroll through here and see if you guys have some additional questions. So Josh follows up here with another one. Can you buy points when recasting a loan? No. The only thing that is getting modified is the monthly payment because you are paying down. When you recast, you're making a large principal payment. So the term of the loan is staying the same. The interest rate is staying the same. You now have a new principal balance because you paid down the principal. So we are just adjusting the required monthly payment to amortize that outstanding balance at that interest rate over the remaining term of the loan. So you aren't able to change the interest rate. So Victor says, I have a question. There's a new LGI home being built near me. They're offering 3.99 interest rate. Is this legit, or why are they offering such a low rate when the average is 6.5%? Because the alternative is cutting the price of that home. So builders are very reticent to do that. They want to keep the values as high as possible. If they generally build in phases, and if the first phase paid $500,000 and they come back to the next phase and they say, hey, you guys only need to pay $450, the first group realizes they are underwater. So they will protect that value at any cost, and they need to move those homes. So if you look, this is all, most of the big national home builders that are doing this are publicly traded. You can look and you can see they're spending on average $30,000 to $50,000 in buy down costs. The average that I saw from one of these builders recently was 5 points in cost to buy that rate down. So again, they have a large margin in these properties. Absent the buy downs, probably a 30% margin, and their numbers are closer to 20% right now. It means about 10% of the home price is being used to subsidize and buy down the interest rate. Now, whether that's prudent is probably the question and open for debate. We probably should do an entire episode on that thing. So I think we had another one here, and I am missing it now. So Willing has another question. Willing's in the mortgage business, for those of you who don't know. So do you believe in split PMI option, more down upfront to have lower monthly to help with the DTI? On conventional loans, you can do a split premium mortgage insurance. So you can pay it all in cash up front, a point or two, and have no mortgage insurance. You can pay, 1% upfront and reduce that mortgage insurance significantly. So there's definitely some options there. If you're tight on DTI, if you have some income that can't be documented or used for qualifying, you had a second job for 8 months, can't be used for qualifying. So you can afford more. There's definitely some things that can be done with mortgage insurance to help you get in and meet the debt to income requirements. So what else? What else do you guys got? Hopefully I haven't missed any. If I missed a question, feel free to throw it in here. Steve, just with a comment here, seeing softening in home prices, is this seasonality or a sign of things to come? None of the data supports that nationally. With rates improving over the last couple of months, the market is firmed. Does that mean the market is strong? Does that mean we are seeing home prices increasing, increase in home sales? No, it just means that it is firmed from where we were seeing in the spring when rates were much higher than what most people expected and affordability was strained. Now, there are certainly pockets around the country, Gulf Coast states especially, pockets of Texas where you are still seeing softening. But generally, most of the country is slightly better than where we were 60 to 90 days ago with interest rates a little bit higher than where they are today. All right, guys, we're going to let Willing have one more question. If no other questions come in, we're going to wrap it for tonight. Willing says, how is it possible for an appraisal to come in $200,000 below the cost to build on a construction loan? Contract, building plan, and specs were given to them, yet it came in $200,000 less. A million different ways this could happen. They could have overpaid for the land. Maybe the land wasn't worth what they paid for it. The easiest one is over improving the property. If you go full Trump style and gold plate everything in the house, and that's not what the market wants right now, you could have spent a lot of money constructing that home, and the market just does not see that value in there. So that is all we've got for you guys this week. Show up next Wednesday. We'll be back here with a new set of questions, new set of slides. We'll go through all the data. Until then, adios, amigos.